Hello.
Right. So before you guys came on, Sonny made a reference to some analyses he was looking at last week in GBPCAD. So we're going to look at that real quick. But then also, we're going to look at what to expect going into the week. So I want to show you guys a little bit about how I approach my week when I'm about to start trading, so that I get the results I want. And then also, if you guys have any questions at all, you can still hear me, right?
Yes.
If you guys have any questions at all, I will answer some of them as we go along. Now,
Sonny, you were talking about GBPCAD, right? So that's the week.
Yes.
That's the week. Monday, Tuesday, Wednesday, Thursday, Friday. Now, the way I trade, Gerard, can we see your face? If we can see everybody's face, that'd be good. This is a private forum, so let's all look at each other's handsome faces.
You can. Yes, you can.
Now, I am what you call an intra-week trader. I can do swing trading. I can do scalping. Scalping doesn't work for me because I'm too busy. And swing trading doesn't work for me because I get bored. If something takes too long to happen, I just can't be bothered. So for me, what works really well, actually just realized, let me put my video on so you guys can see my face too when I'm not sharing my screen. What works for me really well is intra-week trading, meaning I come into a week looking for one trade in one currency pair.
Okay.
Sometimes I can break that down into 2 or 3. So I can take that one trade and rather than enter once and hold for the whole week, I can break it down into little smaller trades, but I'm really looking for one trade in one direction. So I need a directional bias, meaning I need to know this week, am I going short or going long? I don't come into a week looking for trades on both sides because the human brain is not designed to spot bi-directional movement. Your brain is designed as a human being to be biased to one direction. It's hard to look for both a short and a long simultaneously. But if you go into the market knowing, okay, I'm looking for one direction, your brain works that a lot better. And because of that, I need to do some things going in. So first of all, I need a directional bias. Secondly, I need key levels. Let me type this out here so that you guys can see them. Let's see. Let's go. I'm gonna put this here. So number 1, I need a directional bias. Meaning, am I going long or short? In any one week, I'm really looking at only one direction. I know the people who teach you go up, go down, well, those people don't last long in the marketplace, especially in non-trending environments, because the market will kill you. So directional bias, meaning long or short, bull or bear, buy or sell. First thing you need. The second thing you need, let me put this on the side of the chart, are key levels. If you looked at the last 3 sessions on the market maker philosophy, this should make sense why you want those key levels, because those are the levels that market makers are going to be looking at.
The key
You
level.
want them on, the key levels.
Do you
want
mean
them on
previous?
Yeah, go on.
Do you mean previous price levels?
Yes, previous price levels. That's exactly what I mean. Okay. Now you want them on your chart because the market maker is going to have them on their chart. In essence, these are the levels that are going to be determining the market maker's behavior. If you don't know what they are, then you're just going to be food for a shark. So you want key levels. Number 3 is you want significant significant time periods / tendencies. You all have lives, right? You're all busy people. So am I. We don't have all day to be staring at a chart. Most traders who spend all day staring at a chart don't make too much money unless they are learning. There's such a thing called over trading. The more you look at something, the less you see. Have you heard that statement before? The more you look, the less you see.
Yes, sir.
It is very, very, very applicable to trading. You are most likely to spot what you need to see when you are not staring at that chart all day long. The more time you spend looking at something, your eyes adapt to it. And the thing is that you jump out at you, no longer jump out at you any longer. So you want significant time periods and tendencies. And then number 4, you want anticipatory scenarios or anticipated scenarios. You do not want to be interacting with price reactively. Oh, it's going up. No, you want to come into that week or that day or that month if you're a swing trader knowing I'm waiting for price to do exactly this, right? I want it to come in, go to that level, react short from that level of resistance, or to dive to that level of support and bounce, or I expect it to go into consolidation for 2 or 3 days to break out one way, manipulate. So you want to have an anticipated scenario. And you do not take a trade until your scenario plays out the way you anticipated it. In essence, if you get your scenario wrong, you have to either adjust for that scenario or you let that trade go. So you want an anticipated scenario. And then 5, you want a signal. You want something to tell you that your anticipated scenario has happened the way you saw it happening. So your signal, what have I done? I've done, okay. I did that a few times. So let's put 5 signal there. Let's type 4 back again. So 4 was anticipated scenario. And 5 is your signal. And 6 is your entry pattern. Entry pattern / profile. 2 people can see the exact same signal and enter 2 different ways. Right? So you want to have an entry pattern, something that tells you, okay, once I see my signal, these are the rules of my entry. And then finally, in advance, you want to have your money management and your risk management already planned in advance. Actually, there's one more. I've done it again. 1 second. It's been a long day. This is my 4th online session today. I had church, I had leaders meeting after church. Then I had a planning meeting for a project I'm running with my team. This is number 4. So number 6 here was entry pattern. Get that. And then number 8 is your trade management, meaning if the trade does this, what am I going to do? So where is my entry, my exit? When will I change my mind about the trade? When will I take some profit, move my stop to zero, bank some profit, reduce my risk? In essence, I am not fiddling with my trade except according to predetermined trade management scenarios. Because people, they get into a trade, oh, it's going up, oh, I'm losing, then they close, and then they open, and they rules in advance. When price does this, I'm going to do this. If it does this, it means I was wrong. I'm going to shift to this. Does that make sense? Now, all of these 8 things together are what we call a trade plan. In essence, every week you must come into the market with a trade plan. If you're an intra-week trader, if you're an intraday trader, if you're an intra-month trader, whatever, but you need a trade plan. Now, Gerard, I know you're a brand new trader, but Sonny and my Uncle Wale, you guys have been trading for a while. Can you share your thoughts with me honestly? How often have you gone in to a trading week or month with a trade plan in the past? Yeah. The only 2 kinds of indicators you need on your charts are vertical lines and horizontal lines. That's why I use Fibonacci, because they're horizontal lines. Horizontal lines are price levels. Vertical lines are points in time. Now, this is actually in the Market Breaker course when you start the actual course, but let me give it to you for free here. Price action is delivered by an algorithm. You need to believe that. There's a couple of things you need to believe before you start trading. Let me write them on this side. So, things you must believe. If you do not believe these things, you will not be successful. If you doubt whether these things are true, you will not be successful trading. Number 1, price is not random. Price is not random. It is not driven by random market forces, supply and demand. No. It is driven by an algorithm, a computer program that is designed to deliver, and I use the word deliver intentionally, to deliver price to specific levels. Are you listening to me?
Yeah.
Specific levels in the market. You have to believe that. Nothing is random, it's precise. They know what they're doing. There's a system to it. There's a computer program that runs it, not human beings. Now, if that computer program is going to deliver price efficiently, it needs variables. If I give a computer program, everybody here is an engineer of some sort, right? Gerard, what course are you doing again?
Now I'm doing business management, but I did biomedical engineering.
Good. So everybody here has a science background.
Yeah.
For an equation to work, you need to give it variables, right?
Mm-hmm.
So if you are plotting a graph of time against price, what variables do you think that algorithm needs to resolve the equation? It's not a trick question. If the computer program is using variables to plot a graph of time versus price,
Mm-hmm.
what variables do you think you need to give the program to get the delivery system?
Time and price, isn't it?
That's it. Your charts, your markets, your currency pairs don't respect indicators. They don't half the time, they don't even respect news. All the news does sometimes is just accelerate the process of the algorithm. They respect 2 things, time and price. Certain times of the day, week, month, and year, and certain predetermined price levels. And so that algorithm is scanning the information in the chart in the past. And of course, to predict the future, it needs past variables. It's scanning everything to the left side of your chart. So let me put this here for you. When you show up here on this side of your chart, right? When you show up here, 1 second. My computer is just misbehaving today. Okay. When you show up here, right? To move forwards, all the information the algorithm needs to predict the next day, week, month, or year is already on your chart to the left side of the chart. You have to believe that. It is scanning the left side of your chart for levels and time points that it will juxtapose in the future. In essence, it's already predicted in advance of that day, week, or month at what time in the future it will superimpose what level. Your job is to analyze it and make an informed guess. The second thing you need to understand to believe about price is that price is a fractal. I've said that in some of the mentorship classes. Let me explain that. Price is a fractal. A fractal is a phenomenon in nature where no matter how many times you divide a thing, each level looks like the previous level. For instance, snowflakes are like fractals. That's an example of a fractal. What this means is whether you're looking at price on a monthly chart or weekly chart or daily chart or 4-hour chart or an hourly all the way down, it's going to behave the same way. Meaning the same rules that apply on one level will apply on the other level. The third thing you need to believe, following on from the fact that price is a fractal, is this. Is that lower time frames are controlled by higher time frames. Why? Because the market makers are working on the higher time frames. And so the price behavior that you will see on the lower time frames operate the exact same way as the higher time frames, but they are driven by the behavior on the higher time frame. So all you're seeing on the lower time frame is the levels, the times, and the rules of the higher time frame superimposed on that lower time frame. With that in mind, let's look at what happened last week and how we can apply it to next week. Sorry, there's one more thing I forgot to mention. Lower time frames are controlled by higher time frames. Let's put this there. And the final one is that price, number 4, price is, or price will respect liquidity. Liquidity controls price. When I figured that out, my trading went to another level. Liquidity is the unseen puppet master that is, let me take this hat off, that is conducting the movement of price. Price is always coming from liquidity and going to liquidity. Let me repeat. Price is always coming from liquidity and going to liquidity. And so if you understand that, your question now is, what liquidity level is price currently coming from? And what liquidity level is it heading to? If you ask yourself that question and you get the answer correct, things are going to be very sweet for you. one more set of lists. I know this is boring for now, but I'm going to show you how these things all apply on the chart, and you're going to see how this thing, why it's so important. One more set of lists that I want to put here is, let's put this down here. Number one. Now, if you understand how so we're going to call this the rules of liquidity. Where is price coming from? Question one. Question two is, where is price obviously going to? Number two. Who can guess what number three is? Someone want to guess what the third question there is?
Where it's likely to stop.
That
It's going
close.
somewhere.
That's close. You're almost there. You're not too far from the answer. Does somebody else want to try for what number three may be?
Where it's coming from, where is it going to where it will return to or something?
No? Uncle Wally, do you want to try, sir?
Where is it going to change?
Close? Close? The answer is, what is it likely to, I think he's on mute. He probably doesn't realize he's on mute. To do along, finish that?
The way.
Along the way. Case closed. Now, can you see, these look like very simple things, right? But can you see how this could be the difference between success and failure? These sets of things are the things you must have in mind when you sit in front of your chart every day, week, and month. But most people are too lazy to do that. Most people are too lazy to do that, and that's why they lose. Trading is simple, but it requires hard work. It's not complex or too complex, but it requires you doing boring things over and over and over again. If you want a hobby, don't trade. Trading shouldn't be your hobby. Right? Find a hobby that you can enjoy for fun without losing money. If you're trading correctly, it should be boring. Repeat. If you are trading correctly, it should be boring. One more time. If you are trading correctly, it should be very, very boring. We rinse, repeat, rinse, repeat, rinse, repeat. Get your excitement somewhere else. Cool. So let's apply all these now. So we want a trade plan with a directional bias, key levels, significant time periods and tendencies. You guys can still hear me, right?
Yes.
Anticipated scenarios. You need your signal, your entry pattern, your money management, your risk management, your trade management. You must believe price is not random. You must believe price will repeat itself on all time frames. You must believe that lower time frames are controlled by higher time frames, and you must believe price will respect liquidity. You must ask yourself the question, based on liquidity, where's price coming from? Where's price going to? What is it likely to do along the way? With that in mind, let's look at this. So this is the week in GCAD. Now, when we started this week, we would not have seen Monday. All we would have seen, though I'll fix the camera, is this.
Sorry, sir. I just like to get an explanation to something.
Go on.
maybe before you move on, that price will they respect liquidity or something? Will always
Yep.
respect liquidity. I don't know if you can help throw more light on that.
Okay. Do you understand what liquidity is?
Like high volume of market activity.
Yes, exactly. Now, do you know how to spot liquidity on a chart?
Not really.
Okay. You can spot liquidity at a chart at levels where price changed direction, right? Number one. So anywhere you see a uh, a high momentum change in direction, there's liquidity there. But also, you can also learn to spot liquidity in areas where retail traders will be tricked into making stupid decisions. Now, if you have you watched the webinar from Friday, I believe was it Friday? Was it Saturday? Either Friday or Saturday night on YouTube. Have you watched that webinar yet? The Market Maker 3.
I've not been able to look at that.
Okay, please go and watch it.
Okay, sir.
I explain very, very clearly how they engineer liquidity. So I'll give you an example. When I look at this chart here, right? I'm just going to draw this line out here. Notice I can't see what's going to happen, right? Sonny, you picked GCAD, not me. That's why I asked you to do so. So you don't say, oh, I'm just showing you things I've already calculated. See this level here, right? Can you see that level there?
Yes, sir.
There's a naked, I call that a naked high exposed there. Price respects it here, 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 here. I can guarantee you that's a liquidity level going into the week. When I look at the rest of the chart, I'm going to guarantee you that price is going to reach that level and short at some point near it. Should we look? Let's see. I don't know for sure. I'm just guessing. Look at what happens, right? You see, price will go there. You know why? Because there's liquidity there. A market maker is going to know that there is going to be a pool of liquidity here, right? Not only because there's a naked high there, you see this here? Let me change the color for that. You see this movement here? That is a certain kind of order block. We call it a rejection block. So I call these liquidity profiles. That's a name that I came up with myself. Areas on the chart where you know there is likely to be liquidity. When you see two or more liquidity profiles overlap, you can bank that there's something interesting going to happen there. So this exact area here is a liquidity profile. It's an order block. The area above that high is also liquidity profile. It's a naked high. So we know price is going to reach there. When price turns around down here, don't 99% is going to get at least to that level. Don't come out of the trade here. Don't come out of the trade here. Something there, it's called a draw on liquidity. Let me put that in there. Some of you have heard me say that before. Let me write that in there. It's called a draw or a pool on liquidity. Because market makers need high levels of liquidity to drive their movement. They know they're going to be huge amounts of orders there. Look at what happens when it gets there. Can you see that? It gets there into that region. And what does it do? Also, I forgot to mention, there's also going to be another liquidity pool above this high. That's one there. It's going to be another one above this high as well, right? And there is also another order block there. Can you see that? That whole candle there, that big candle there to the top is another block. Can you see that there? So there's liquidity pool here. There's one there. There's one there. There's one there. Price will get there. So it's going to clean up all these orders here. You see, it turns a little bit. but there's more money up here. So they're greedy. They're going to go back. And once they get that one, look what happens. Boom, it drops back to that level. It hangs around there for a while, right? And while it's there, it forms several other order blocks. There's one there, right?
So, sir, if I'm
Yep.
putting you correctly, a liquidity pool is like a point where the graph slightly goes above the point of liquidity.
A liquidity pool is an area on a chart where you know from experience as a smart trader that there's going to be a huge amount of orders resting.
Okay.
Several traders are going to put an order there. And I explained some of the reasons why in Friday's webinar. So go watch it on YouTube.
Okay, sir.
Things like breakout traders, stop hunts, people putting their stop losses. I'll give you an example. If you shorted from here, right?
Mm-hmm.
Where would you put your stop loss, Sonny? Let's assume you enter the trade here. At this red line, where are you likely to put your stop loss?
It should be on top, yeah, somewhere around there exactly.
Above the high, right?
Yeah, above the high.
Okay. So if you entered down here at this level there, where would you likely put your stop loss?
Most likely on that high.
Above this high. Okay. So if you sold here, if your trade was a sell, your stop loss is going to be a buy, right? To close the trade.
Exactly.
Okay. Please make sure you guys watch Friday's webinar. But if you entered with a sell, you need to come up with a buy, either with your take profit or with your stop loss. If a market maker really wants to sell, they need to trick someone into buying. If they drive price to clean out your stop loss, to trigger your stop loss here, for this here. So when they trigger this stop loss, they have activated your buy trade. In essence, you're buying so they can sell to you, and then they drive price where they really want to go, which is down. That's just one example of engineering liquidity. I gave several on Friday. But we call that a liquidity pool because we know there are going to be orders there based on that high. That's one example. But anyway, so notice how at the start of the week, I have a directional bias. Why do I have a directional bias? Because I expect price to come to this level and short. So that has given me a directional bias. So when I come into the week, what am I looking for?
Short.
What direction am I looking for?
Sell.
A sell. I'm not interested in any of this over the course of the week. Except, of course, I could do it the other way. I could say, I know price is going to reach that level. Therefore, I'm going to start the week and buy, right? That's another way I can have the directional bias. If I expect price to come to that level, I can start the week looking only to buy. And I know once I get there, I come out. Does that make sense?
Mm-hmm.
So if I'm taking an early week trade, my bias is a long. If I'm taking a late or middle week trade, my bias is a short.
Okay.
So until I get to that level, I'm not interested in the short. So for instance, when price does this, when price gets here and starts coming down, am I going to sell?
You should not.
I should not be looking to sell. In fact, the beauty of a directional bias means that you see if you're going up, every drop in price is an opportunity to enter. So rather than seeing this as a sign to go short, I'm going to look at it as an opportunity to enter this trade. If I put my Fibonacci there, Look, that's almost perfectly. Let me see, 1 second. So that's been it 50%. That is a buying opportunity for me because I know price is getting to that liquidity point. I know it's going there. So every drop in price gives me a chance to get on board the trade. On the flip side, once price has reached that level, I now switch my bias to a sell. From this point on, I'm not looking to buy anymore. So even when price comes back, right? All I see that is an opportunity to enter the trade. So if I miss the original move down, what a dumb trader thinks is price starting to buy, that's an opportunity for me to enter there. Does that make sense?
Mm-hmm.
So when you have a bias, every time price moves against your bias, it's an opportunity to buy or sell at a better price. Does that make sense? So would you rather be selling here or selling here?
I'd rather be selling at the second point.
At the second point.
Yes.
So somebody, good to see you, Peter. How you doing? If we can see your face, that'd be great. So the guys who do not have a directional bias think price is going up. I have a directional bias from this point onwards that it's going south. This is merely an entry opportunity for me. But what informed that directional bias? A key level. And notice that key level happened before the week. This was Friday last week. This high here formed at Friday last week, right? But even before it formed at Friday last week, let me show you how beautiful this thing is. Let me remove these two levels here. So let's put this dividers in again. So this is the last 3 weeks before the week that just happened. I'm looking for key levels now. Key levels means at the area where price currently is. Good to see you, Peter. At the area where price currently is, what are the significant liquidity levels in the past? And I'm interested in them on a 4-hour chart and above, right? Because those are the levels the market makers are looking at. I taught this on Friday or Saturday. Market makers are not interested in anything from 1 hour downwards. They go from monthly and they stop at the 4-hour chart. So let's go to 4-hour chart. Again, sorry about all this writing. This is okay. You know what? Let us open another one so that we don't mess up with that one. Actually, you know what? It's fine. I'll draw them out on a 1-hour chart, just so that we're looking at the exact same levels there. But we're going to go for the really obvious ones, the things that we should be seeing on a 4-hour chart. So remember, again, we don't have any of this information here. This was Friday, the week before. We're not interested in that. We just want to look in the past. Coming into this week, what should we have seen? Let's drop some key levels. I want you to look at what this is going to look like magic in a bit, right? I call them my magic lines. I don't do pivot calculations. I don't do any of those indicator-based things because price gives you all the keys you need. I'm going to leave, this, okay, I'll leave, actually, no, these are very close. So I'm going to remove that one.
Similar.
And just leave those other ones there. So watch.
Yeah.
Watch magic happen. So I'm looking at significant highs and lows, right, in the past.
Yeah,
I'm also looking at significant consolidation points. So where did price change direction, or where did it spend plenty of time? It changes directions at highs and lows. It spends plenty of time at consolidations. It's going to throw a few of them, not too much, just a few. Okay, that's a consolidation there. I'm going to put that one there.
What do you mean by consolidation, sir?
When price is in a tight range in an area.
Okay.
So this is the consolidation here. And so you drop a line at the center of the consolidation, the average price of the consolidation, because those are liquidity points. The fact that price changed direction there or doesn't want to leave that place is a sign. I shouldn't have done that. Is a sign that there are high levels of liquidity there. Which ones am I missing now? Let me see if I can add one or two. Okay, so that's a low there. And I would potentially put another one here. Cool. So I've just drawn those lines, right? That took me less than 5 minutes.
Okay.
Right?
Yes, sir.
Now, bear in mind, all these lines are from all these lines are from the left side of the chart. These are lines you could have drawn before the week happened. They're not hindsight, right? Right?
Yeah. Yes.
Come on, talk to me.
Yes.
Okay. Now let's go into the rest of the week and see how the magic happens. Look at what price does every time it gets to one of those levels. Where did this high form? At that level, right?
Mm-hmm. That's the first.
Can you see that?
Level. Yeah, that's the first.
And in fact, I could actually predict the exact high. Look at this consolidation level here. Can you see this Can you see there's a consolidation there in this area? Can you see that?
Mm-hmm.
So I'm going to drop a line at the midpoint of that consolidation. Notice how price respects it here and there. In fact, let me refine that line to touch that low there. You see that there?
Mm-hmm.
Let me change the color of that line to purple just so you know the line we're looking at.
Okay.
So you see that line there?
Mm-hmm.
Watch what happens when the week starts. It's like magic, isn't it? See?
Mm-hmm.
You see that? That was that high there.
Yes.
Can you see it also predicted this high here? You see that?
Yeah. Yeah.
Can you see that this line here predicted this high here?
Yeah. That's a price.
This one, yeah, this one from all this way down here predicted this low here.
Mm-hmm.
And if I were to go further back in time, or let's zoom out to a higher level, you see this low of the week here?
Mm-hmm.
I'm just going to drop a line there. Let's go back in time. I can bet you that line is a significant level in the past. There we go. See that?
Yeah.
That's a consolidation.
It's a consolidation of another
That's
point.
a low there. Right? And so by marking those key levels going into the week, you are preparing for price to do things at those levels. So you're not shocked when this high forms here. When this high forms here, you expected it to form. You didn't know what was going to happen, but you went into the week knowing something significant could happen at that level.
That's what you mean when you say price will respect liquidity.
That's what I mean when I say price respects liquidity. There you go. Now, number 3, significant time periods and tendencies. Remember, I've been saying this to you guys all year long, for those of you who've been around for a while. In a down week, 70% of the time, you can expect the high of the week to form between Tuesday and Wednesday. In an up week, 70% of the time, you can expect the low to form between Tuesday and Wednesday. Now, actually, I just realized that I haven't, one quick second. Let me show you this. This should blow your mind. I don't know if it will, but it should. Look at a daily candle. Let's take a candlestick, right?
Okay.
See this candlestick there? Let's pick, actually, let me use this chart. Let's get rid of that annoying indicator. It's useless. This is another thing I saw that changed my life where trading is concerned. See this big candle here? Let's draw it out so we can look into it a bit deeper when we see this candle here,
Yes, sir.
right? That white candle.
Mm-hmm.
Is it an up or down candle?
That's an up candle.
Okay. Where's the open of the candle? There.
Yeah. No, an up. Yeah, an up.
Sorry.
At the bottom.
Sorry, open. Yeah, that's the open of the candle, right?
Yeah.
The candle opened at, let's see, let's touch this candle. Come on, give us some details. Okay. So the candle opened at 0.9576. The low was 95685. The high was 96429, and the close was 96355. Without going into this candle, I'm willing to bet you, right? I'm going to make you a £5 bet.
Mm.
I haven't looked at it yet. That the candle opened, went down, formed the low, moved to the high, and then closed slightly down from the high. Who wants to bet me £5?
Candle opened, went down.
So I can buy some chicken and chips.
Yo, please, can you say that again, please? Please.
I'm willing to bet you £5 or $5, whoever wants to take my bet, that when price opened down here, it first went down to form the low of the day before going up to form the high of the day, and then it closed slightly down from the high of the day. Does anyone want to bet me £5 against that guess?
Me, I'm a child of God. I don't bet.
You don't bet, okay?
I'm
All
just
right.
joking. I'm just joking.
So we've dropped the line on that day. This is the 5th of June, right?
Yes, sir.
Now this is a 4-hour candle. Actually, no. I need a daily candle to make this point. Sorry. No, I need a daily candle to make this point. Let me delete that.
Oh,
I need a daily candle to make the point. So let's find. Okay, so that's the okay. So yeah, that still works. That's the daily candle, right?
okay.
So that is the 5th of June. Now, one day, so a daily candle will be a divider on an hourly chart, right? What shows up as one candle on a daily chart is one divider on an hourly chart. You guys all know that, right?
Mm.
On a monthly chart, the dividers are years. So you see this lines between here and here.
Okay.
That's what I mean by divider.
Okay.
Between there and there.
Is a divider.
Right? That's the divider.
And on a
On
daily.
a monthly chart, that's 1 year.
Okay. Okay.
Does that make sense?
Yes, sir.
Sonny, do you understand that? We can't hear you.
I think Mr. Sun is muted.
Still can't hear you. He's not muted, but we just can't hear him. Is your volume up?
Hello, can you hear me now?
Yeah, we can hear you now, yes.
Okay, I said just like on the 4 hours chart, that's for a week.
Yes. So a monthly divider is a year. A weekly divider is also a year. A daily divider is a month. A 4-hourly divider is a week. And anything from 1 hour down is a day. 1 hour, 30 minutes, 15 minutes, 5 minutes, 1 minute. These are all the dividers a day.
Okay.
So let's go to the 5th of June. Remember that bet I made you. I might
Yes.
be wrong. There are times where it is wrong, but it is always almost correct. 5th of June. Can you see that if you had bet me that money, Gerard, you would have lost? Price opens here.
Where is that line?
Right.
I can see the line again. Okay.
5th of June. I deleted it because we found the 5th of June. Okay, this is the 5th of June here.
Yeah.
This is the 5th of June. So price opens there, right?
Yeah.
And comes down. You see that? See that? To form the low of the day. Yes, Uncle Wally, it opened, went down to form the low of the day, right? Then it went up there to form the high of the day. And then it closed slightly down from the high of the day. Can you see that there? Both Gerard and Sonny.
Yeah, I can see it.
The space in between those two is the body of the candle. I'm going to put that shape in there. See this? This is the body of the candle, of the daily candle. That's the top wick. That's the bottom wick. Do you want to bet?
No, that's
Let's
correct.
Let's go back and look at the 5th of June on this chart here. 1 second. There we go. 5th of June. Can you see that? You see? That's the body of the candle. Can you see that?
Wow. Okay, yes. The exact body of the candle.
Now, Gerard, what you just said, wow, is what I said when I saw this for the first time. This changed my entire trading life. Why? Because remember this here. Remember this here. Lower time frames are controlled by higher time frames. Remember that?
Yes, I remember that.
So if I can find a time frame that will be the hourly divider on another time frame, this magic will work.
Oh.
If I can predict what I think the next daily candle will be, I can go into anything from an hour downwards and work the magic.
Wow.
Now, the same principle works with the weekly candle. Let's look at the weekly candle now. Let's use a down weekly candle. So let's use this one. You see this candle here?
Yeah.
That is, let's see now, what week is this? Let's put a line there. That is the week that had the 23rd of February in there somewhere.
Okay.
In fact, let's not even go too far. That's too far. Let's use this one here. See this week there?
Yeah.
So that's the week that had the 24th of May.
Okay.
So write that down in your brain, 24th of May. Okay. Let's do the opposite. Let's draw the high and the low. Right?
Mm-hmm.
That's the high of the week. Sonny, does it look like magic?
I'm following.
That's the low of the week, right? Right?
Yeah.
I'm going to bet you this week started at this price. It went down into that level, right? To form the low of the week. It went all the way up to form the high, and then it closed there. Let's go look at it. Of course, if we look at a weekly candle, what time frame has a week as a divider?
4 hours.
4 hours. So let's go into a 4-hour chart.
4 hours, 1 hour.
And let's look for the week that had the 25th. What day? Let's see. It was the let's put that there. The 24th of May, right? So let's go and find the 24th of May on this chart. 1 second, what's going on? 24th of May. So that is 24th of May would be this week here. No, it's this one. 24th of May is, no, 24th of May is, what week are we looking at? Yes, this one here, right? This week. This week.
Yeah. Is this one?
This week.
Exactly.
Yeah. So that one here. This one. And you see that the same thing happened, right? Price started here, went up, right, to form the wick. Can you see that?
Mm-hmm.
Came down. In this case, it still, messed around there twice, but then ultimately came down, formed the low there, right?
Yeah.
And then came back and closed there. Can you see that? So this is the body of the candle.
Oh, Pio, I see this now.
1 second. 1 second. My battery's about to die on my phone. Give me a second.
I see it now.
You see it, Gerard, right?
Yeah, I see how the candles are formed now. As it slightly goes up so that the wick can be formed. Then it comes back it comes back to where it was before and then goes down so the wick can be formed. Then it goes back up.
Goes back and okay. So you get it, right?
Yeah.
1 second. Let me put this back up. All right.
And
let's go back and look at
where the stop points happen.
Yep. So let's go back and look at that week now that we've seen that.
Wow.
So we're looking at the 20. Oh, there it is. And can you see that it predicted the body of that candle perfectly? Can you see that?
Mm-hmm.
It predicts the body of that candle. This should be here actually. Sorry. Perfectly. Because that's how it. I noticed in this week, the wick is very small in this week. The wick is very small.
Mm-hmm.
That's why the difference in the candle was very small. Let's take another candle with a big wick just so we see the process here.
There's this candle on 1st of May.
This one here, right?
That's April. That's 26 April. Well,
So let's use that one.
Has a high wick.
That's what I want to show you, just to see it so you can see it clearly.
Okay.
So there's 1 second. There we go. This thing does my head in sometimes. Okay, there we go. So that is the week of the 26th of April, right?
Yes, sir.
Let's go back down to, because we're looking at a weekly candle. Let's go back to a 4-hour chart. 26th of April. 1 second. So 26th of April.
So now you're explaining the principle where longer trades control shorter trades.
Longer time frames. So
yeah.
Look at this week. There we go. There we are, 26th of April, right?
Yeah.
Now, so that's this week here. This one here.
Yo, why is it that when I have a question, please. You choose a candle.
Actually, no, sorry, no. 1 second, sorry, no. It's not that week. It's this one, actually. It's this one here. This is the week here. Carry on, Gerard.
Okay, I was going to ask that you choose a candle from the weekly charts, and when you go to the daily, okay, well, I guess it's because it's weekly. It kind of spans through 2 days or something like that.
Yes, because the week is not perfect. The week starts on Sunday night. It skips Friday and Saturday, and it goes to Friday evening the next day, the next week. Does that make sense? So the trading week starts on Sunday evening,
Mm-hmm.
and it ends Friday. But can you see this here?
Yes.
See, the week started there.
Yes, sir.
You can now see this is the big wick we saw, the big spike wick we saw, right?
Okay.
And it comes back down below the open. So on a down week, it'll first go up. That's the manipulation. Then come the correct way and then retrace back into it. So this is the body of the candle. That's the body of the candle there. And let's go back to weekly chart. And you will see it like magic. There we go. Can we see? That's the body of that candle, isn't it? See that there?
Yeah.
Do you understand the significance of this?
You can actually.
Sonny, do you get the significance of this?
That's the question I was going to ask. I really do not know what it implies. Yes, we can see the body of the candle in the weekly chart. And of course, when we scale down or drop down to the 4 hours, we can see the activities that indicates this body in the weekly chart. But what really the significance is what I don't.
Okay. The significance is when you come into a week or a day, price is going to open, move in the wrong direction, right?
Mm-hmm.
Form a high or a low, and then travel in the right direction.
Ah, wow. That's like light bulb moment.
Does that make sense?
Did
you get that?
Wow, that's a light bulb information.
Price is going to move first in the opposite direction of where it really wants to go, to find a previous level, right? And then that level is going to send it in the right direction till it gets to another level that is going to bring it down a little bit to close. You get that? Let's look at 4-hour charts, for instance, because these are the ones that I really trade because I'm a weekly inter-week trader. Look at this here. Price opens here, right? It goes above there to find resistance, then it goes down. You see that? On an up week, the opposite happens. The next week is an up week. Price opens here. It first goes down to find support, and then it goes up. Can you see that? The same thing on a day. Let's go to a 1-hour chart. Same thing in a day. Price will open at midnight, right? It will go up and form the high of the day. And remember I told you the high or the low of the day will always be formed between 6 and 10 a.m. London time or 12 to 3 p.m. London time.
Yeah, 6 a.m. to 10 a.m. and 12 to 3. Yeah.
7 times out of 10. Let's look at where this high forms. It forms at 9 a.m. server time. Now, this server is in Cyprus. So 9 a.m. on this chart is 7 a.m. in London. So it forms 7 a.m. You see that there?
Yes, sir.
The next day, it opens here. It comes down to form the low of the day. What time does it form the low of the day? 8 a.m. Cyprus, that's 6 a.m. London. Okay. You can see that, right?
Mm-hmm.
Travels finds the high and then retraces a little bit. Remember this here. Directional bias key levels, significant time periods and tendencies. I've just shown you the time periods and tendencies. It could be the hours in a day or the days in a week. So coming into this chart here, let me open another GCAD chart to show you. Actually, no, we need to use this one because it has all the levels. It has all the levels. So coming into this week, right? That was the Monday. Coming into that week there from the previous Friday. If we've dipped down into, so you see, we've reached this level here, right? Price has started to go back. We would expect it to find a liquidity profile to form the high of the week. It's already formed a low here, right?
Mm-hmm.
The question is, where is it going? There's only 3 places it can be, or 4 places it can be going to. This is number 1, this high here. This is number 2. This is number 3. There, above that one, or that high. And this is number 4. These are the 4 places it is likely to react to. But it's starting from down here. What's the difference from here to there? That is 422 pips. Is it likely for price to travel 422 pips in 1 week? Sonny, what do you think?
Yes, it is possible.
But is it likely?
In 1 week,
Yes.
it is likely.
I would disagree.
In
I
1 week.
disagree.
I think
Okay, no, it is really not likely because
Not
there will be
likely.
kind of
Yeah,
retracement along the way.
It's not likely.
Even though I don't trade regularly, those sharp peaks occur. Those sharp peak travels occur very
rarely. On average, this pair on average is going to travel around 250 pips a week.
Okay.
On average. So we can almost ignore that there. Now, this one here is 300 pips. That's more likely. So, and this one here is only 174 pips. Is it likely for price to travel only 174 pips a week? Again, it's possible, but it's not likely.
It's not likely, no.
So by elimination, we've done the directional bias, we've done the key levels, we've done significant time periods and tendencies. We understand price will start to drop and then move up, or start go up and then come down, right? We know to be looking between 6 to 10 a.m. every day, or 12 to 3 p.m. every day. And we also know to be looking between Tuesday, Wednesday, and Thursday every day for the significant move to happen, every week, for the significant move to happen, right?
Mm-hmm.
Now look at an anticipated scenario. It's unlikely for price to travel 400 pips. It's possible, but it's unlikely.
Mm-hmm.
It's also unlikely for it to only travel 174 pips. It's possible, but unlikely.
Mm-hmm.
If I put these things together, the most likely scenarios are price is going to travel somewhere between 200 and 300 pips, right?
Mm. Yeah.
Right?
Yeah. Yes, sir.
It is going to come to a key level from the past.
Mm.
It is going to get there between Tuesday morning and Wednesday night or early Thursday morning.
Mm.
Right?
Yes, sir.
And it is going to react.
Wow.
That's a highly probable scenario, right?
Yeah.
I may be wrong, but I'm going to go into the week with that as my scenario. Now, when you first start trading this way, if you miss your scenario, if your scenario turns out to be wrong, just ignore it. Don't try and be cute. Just say no money for me this week. As you get more experience, you learn how to change your scenario on the fly.
Mm.
As you get more experience, you say, okay, no, this is not happening, so this other one will happen. So sometimes I will have 2 or 3 scenarios going into a week, either A, B, or C.
Wow.
And I move from A to B or to C as price unfolds.
Wow.
So with those 4, I'm now looking for a signal. So as the week starts, what happens? Price comes up, it gets here. Notice it reacts a little bit and comes back down. But remember, I've told myself this is unlikely. It could have just kept going all the way down. That could have happened. But I know it's unlikely, right? So when it gets here and it comes down a little bit, I ignore it. In fact, if I missed this entry here, I see this as another chance. So when price comes here, I will put my stop loss at the last low before there, which will be this low. I'll put my stop loss here, right? So that's 47 pips. Or if I choose this one, that's 30 pips. But I still expect it to keep going up, right?
Okay.
Now, on Tuesday, it hasn't reached. So I'm looking for one of these two levels. Remember, this high and this high are the ones I'm really watching.
The high liquidity points.
The high, exactly. And they are at, so let me remove all the other red lines because I don't want you to get confused. Let me remove all these other red lines so you can focus on those two ones. Now, you will draw many of them coming into the week. But then as the week begins to go on, price will begin to show you which ones it's looking at. Now, remember I said I would usually draw this only on a 4-hour chart. I only drew them on a 1-hour chart because my 4-hour chart was cluttered. 1 second, no, I missed that one. So let me put that one back there. That's that one that formed there, yeah? I'm going to put this in purple. Purple is my 4-hour color. And I'm going to, 1 second. No, let me not cheat. Let me not cheat with this. So I'm going to remove all the other lines that are not related to those two there.
Wow.
Just so you can see what I'm looking at very clearly. I'm going to leave that there as well because that's going to be a 4-hour line. This is going to be 4 hours. This low here, you see this low here?
Mm-hmm.
That's going to be a 4-hour level. From experience, I can tell it's going to be a 4-hour level. I'm going to remove the rest. If we go to 4-hour chart, ignore the writing, right?
Yeah.
Let me blow this up.
I think you can even take the writing out. I think most of us are.
No, I want to leave them there for a while. I'm going to leave them there for a while. Because I have something to do with them. Now, can you see this level here?
Yes, sir.
This is 2 weeks ago. That's a 4-hour level, right? Right?
Yeah.
Okay. The week before that, you see that line there?
Uh-huh.
Here, that's another 4-hour level. You see how many times price is touching these 3 lines? So if we go into the rest of the week, this is a 4-hour week now, of a week on a 4-hour chart. Price comes up, right?
Mm-hmm.
And on Wednesday, gets to the first of these 2 levels. Remember, we're watching this level here and this level here. Let's go back to a 1-hour chart so you can see. I don't want to confuse you.
Yes, please.
We were watching these 2 purple lines here. You can see them, right?
Yes.
You see them, Sonny?
Yes, sir. We can see them.
On Wednesday, price gets to the first one. And there is a sharp reaction.
Okay.
And let me remove this there to show you this. It causes a market structure break there. Can you see that? It broke market structure here.
Yeah.
That is my signal.
To pull out.
No, to enter. Well, to pull out of the old trade, but to enter this one. So that's my signal there that level has now been respected. So if I was in this long from here, I'm out. I'm getting out here. Now, if I get out here and I got in all the way down here, that's still, so even though, first of all, by the time price gets here and already forms an engulfing, I will be out here. I'm not going to wait for the market structure break. Price gets to that level and there's a sharp reaction, I'm out. Even if it then goes further up, I don't care, right? If I enter here, let's assume I entered here at this level here, right? Or I said this one here. So I entered here, right? I put my stop loss there. That's 34 pips. And I get all the way up there. That's 150 pips. That's 5 to 1. You see that? Why are you greedy? Why are you waiting for it to get all the way up here? Just get out, because you already marked this level as a significant level, and price gets there on Wednesday. And what time on Wednesday does it get there? It gets there
3 o'clock, 2 o'clock Cyprus time. That's about
2 o'clock Cyprus time. That is 12 noon,
12 noon,
right?
Yeah.
So it gets there on a day we expect something to happen, and at a time of the day we expect something to happen. If you were in the long, close. However, if you were waiting for a short, that is your signal. But the fact that that is your signal doesn't necessarily mean that's your entry. You don't just enter when it reaches there. There's many ways you could do it. One, you could enter at the bullish and at the bullish or the bearish engulfing there. So you could enter here, right? See that? Yeah. If you enter there, you have to place your stop loss above this zone. That's 85 pips. Because you don't yet know whether that will hold. You haven't yet seen the market structure break. So to be on the safe side, you need to put your stop loss there. Because price could very easily come back and take out that high. You see that?
Yeah.
It could come back into that same zone to the middle of the zone and take out the high.
Okay, so the reason for putting the stop loss there is so that if it passes that high, you still don't lose money.
You still don't lose money because at this point, all you know is price is respecting this zone.
Okay.
You don't know where in the zone the orders are resting.
Okay.
So if you trade this way, you'll be 50% successful. Now, if you're talking about money management and risk management, if every time you win, you make 5%, and every time you lose 1%, even if you're only 50% accurate, you're still going to make plenty of money.
Wow.
Right?
This is so good.
If you take 10 trades and you win 5 times 5 is 25, right?
Yes, sir.
You make 25% profit.
Mm-hmm.
If you lose the other 5 times 1 is 5.
Mm-hmm.
You're going to lose 5%.
Mm-hmm.
So at a 50% success rate with 5 to 1, you're still going to come out with 20% equity profit over every 10 trades. And that's amazing. Would you agree?
Yeah.
If every 10 trades, your account increases by 20%, you'll be a millionaire soon.
Mm-hmm.
However, my own personal entry pattern, I'm not entering here. Why? I'm waiting to see a market structure break.
Okay.
And I want to see at least a 1 hour market. These are my personal rules. A 1 hour market structure break where a daily range is reversed. So price starts this day here, right? Look. Even though the day is going down, we know that based on what we saw, it should go up to find a resistance level, right? If this is a daily candle, let's look at this candle. This is the 24th of June. Let's look at a daily candle for the 24th of June.
It has to go and form the wick first, right?
Yes. So, let me open another one here. GCAD. GCAD, and let's do properties. Wow. Black and white. Control G, Y. Candlestick. Daily candle. Let's look at the 24th of June. That is this candle here. That's this candle there, right? See that? That's the candle that caused price to turn. You see this?
Mm-hmm.
The price had to go up and find a resistance level. Now I told you it's 80% of the time where if it goes down, it'll start down. But so there's the exceptions. This is an exception. And it's an exception because it's a turning point. So price starts off, right? Cleans a level down there. Actually, it's not an exception. It's actually the right, no, it's the right direction. Price starts, opens, goes and forms a resistance, and then comes down and then closes in the middle.
Okay.
That's exactly what we see here. Price starts here. Here. No, not you. Delete. Starts there. It finds a resistance level above the open price where a significant historical level and at a liquidity pool. Can you see that? It's going above the high to, this is a 4-hour level. Remember, higher time frames control the lower time frames. Remember all that? So a 4-hour level, when it reaches there on a 1-hour chart, it has the reaction. But I'm not entering there. This is my entry pattern. I wait for market structure break. I wait for the daily candle to reverse. And then I'm looking for what I call, remember, if I want to sell, I'm looking to sell at a premium. Did you guys watch my video on premium and discount?
Yes, sir.
So price has to come back to above 50%. Remember?
Yes, sir.
Because anything above 50 is a premium. Anything below 50 is a discount. If I'm selling, I'm not selling at a discount. Market makers don't sell at discounts. Also, I showed this to you, remember, that the zone between 50 on one side or 38.2 on one, so this zone there is a fair zone. Remember I said that, right? So we're looking to sell literally above 61.8. Price comes back there, see? It gets to 50, it reacts a little bit, but I'm waiting for it to get to 61. It gets to 61, it doesn't react at 61. It reacts at 78.6. See that there?
Yeah.
When this forms, this is when I take my entry. Because this has shown me that price is no longer just reacting to this zone. It has now respected this high. Does that make sense?
Yes, sir.
Does that make sense?
Yeah.
I can then enter here at 6. So at the reversal there, I put my stop loss there. What was a 85 pip stop loss is now a 50 pip stop loss. Can you see that? Can you see that?
You can see.
And if I were to drop further down to a 15-minute chart, it's even clearer. So look at that there. On a 15-minute chart, my entry would be just beneath the body of this candle there, because that's the engulfing on a 15-minute chart. See that there? When price goes up there and comes back and engulfs that candle, that's my entry. Because the 4-hour chart is controlling the 1-hour and the 15-minute.
And your stop loss is that previous
Entry there, stop loss is there. What's my stop loss now? 35 pips.
Here, please, just one small question. When you say engulfing,
Yep.
what is it?
An engulfing pattern is when one or two candles maximum. It should not be more than two. Anything more than two is dodgy. One or two candles maximum reverses the previous candle direction.
Okay.
So here price was going up at this candle,
Mm-hmm.
and then the next candle completely reverses it down.
Okay.
Here price is going down, the first candle and then the second candle completely reverse it going up.
That's an engulfing.
That's an engulfing. So here, this is the engulfing level for this one.
Okay.
Again, these are all these things I explained in the free videos on the YouTube site.
Thank
Go
you.
back and watch all those free videos. They're all there.
Yes, sir.
That's the engulfing level there. And on the downside, this is the engulfing level here. So once price pushes up above that level, it's engulfed this candle. When it pushes down beneath this level, it's engulfed this candle. Does that make sense?
Mm-hmm.
And an engulfing will always create a new order block, because now this is the order block there. So engulfings create order blocks. And this is the order block there. Does that make sense?
And what do you call it? Well, I'll go and watch the videos. Let me know this. I was going to ask what you call another block, but I'll watch the videos. I won't bother.
Go and watch the videos.
Yeah,
Talkway explained an order block on Monday last week.
Okay.
So go watch the mentorship for Monday last week.
Polish order blocks. Yeah, I'll go check it out.
So now let me ask you this question. If you entered here and you had a 35 pip stop loss,
Mm-hmm.
if you came all the way down here,
Mm-hmm.
that's 120 pips. That's 4-1. Right?
Mm-hmm.
Would you rather have that, or would you rather have entered here I've entered here at the engulfing here? That is a 75 pip stop loss.
Okay.
It's a higher entry, but all it would make you is 125. Can you see that? That's not even up to 2-1. This entry here wouldn't have given you up to 2-1. But being patient for my entry pattern here gave you 4-1. Does that make sense?
Yes, it does.
That's the beauty of an entry pattern. Now, my risk management is I am not going to risk more than 1% on this trade because I could lose. It's not guaranteed. Even after all this perfect analysis, it is very possible for this trade to have lost.
Mm.
And so my risk management is maximum 1%, at worst 2%, but I go with 1%. My money management is if I am going to risk 1%, so that's my money management, sorry. My money management is the fact that I'm only risking 1%. My risk management is to get this to 1%. If my account size is small, I can't take a 75 pip trade for the risk. I need to frame a trade where that risk comes down. For instance, I will not take a trade with a risk more than 30 pips. The style I trade, 30 pips is my maximum risk. But you can see 35 is a lot better than 75. And I need to know, where do I expect price to come back to? It's like magic, right?
Mm-hmm.
Look at this level here. See this level here, right?
Yeah.
Again, this is from weeks before. This is not hindsight. What I'm trying to show you is this is not stuff that happens during the week. No, you know this from before the week. See that level there?
Yeah.
Once price reacts there, where does it react again? There.
Yeah.
It comes back there. Where does it react again? There. What is just beneath this level? An order block. This is the order block there. Can you see that? Even if you don't know what it means, Gerard, just go back and work, but that's an order block. Sonny, you understand what I mean by order block, right?
Buy or sell.
The moment price dips beneath that level and gets here and reacts, I am out. Why? It's a Friday. You know, I keep telling you guys, you get to a Friday, start looking to close your trade. Because again, from significant time periods and their tendencies, I know price is very likely to react on a Friday. If the trade has been going one way from Tuesday or Wednesday, and we get to a key level and a liquidity pool, that's the order block beneath that level. So there's a low here, price has tapped into that liquidity pool, and it starts to react the other way, I am out. And so my trade management is I enter here, and once it gets here and reacts, I'm out. So on this trade, I would have maybe, if I didn't get out down here, once it reacts there, I'm out for exactly 100 pips. That's 3-1. That's still very nice. And notice how everything I would have done this week was already set up from 2 or 1 week before, 1 or 2 weeks before. Does that make sense?
I'd like to ask a question.
Go on.
If we move the chart today, right?
Yes, sir.
Okay, sir. I'm a little bit confused sometimes with them. Okay, I would love to ask that place that it's an order block.
Yep. Which one? This one down here?
Before the other, okay, we have the other block down, shaded,
Yeah.
and on top of it, we have the low.
Yep.
On top of it, if we go on top, somewhere around there. So why is this? Why is that other place not another block?
It is. You're right. You're perfectly right. No, it is an order block. Right? But we expect it to be violated. Why? It's already been violated once. That would be the other block there, right? Well, price has already violated it once. Does that make sense?
Okay, it makes sense.
It's already violated it once, and it's broken market structure to violate it. So that is now irrelevant. Even though it holds it here, we don't expect this to hold. We want it to come to the next one. We may be wrong, right? But we expect it to come back down to the next one, which is here. And you may see next week that price comes to this level or here and comes back down again to find the final one. It's not necessarily going to happen, but this is a likely scenario. That now that if it breaks through this level, we know it's coming for this one. Right? Because this is where the next significant liquidity is. And also, the fact that there is a low here means there's going to be liquidity resting beneath that low. So you see one liquidity profile matches with a second. Like I told you, when you see 2 or more liquidity profiles overlap, there's a significant level, there's an intermediate low, there's another block. You know price is going to dip in there.
If I can ask another question, if it will make sense.
Go on.
That same place where we have the low that we say, okay, there was another block, or that you confirmed there's another. It's an other block that was violated. Could it be that yes, it's another block, but not like strong enough, because it made a temporary top before that high. Before that high on Wednesday.
Okay, so now
it was easy for market to pull through it downwards.
Good question. Good question. See, we've anticipated a level there. Remember, we came into the week with a plan. Let price reach that level, then short. That was our anticipated scenario, right?
Yes, sir.
So we are looking for signs that scenario is being respected. Does that make sense?
Yes, sir.
And on this, so the first sign is price reacts. The second sign is it breaks market structure. And then the next day, price closes beneath the open on the next day. Can you see this? So for 2 straight days, price closes beneath the open price on 2 consecutive days. If we're looking at an up candle, we expect price to close above the open, right? So everything is telling us that now that price has reached that level, it is now coming down. You get the point?
Yes, sir.
All the signs are, so if it's coming down, we expect it to violate this order block. Because now the directional bias is south. It's already stabbed through this level. We expect it to come back to at least that low there. And its first hold will be the order block beneath that. It's bounced up. It could very likely turn around this next week and go down again. But we're taking bust stops. So we're going from one significant level to the next significant level. Does that make sense? One significant level to the next significant level.
So
Some of this now, some of the tendencies will make themselves clear. Go back and listen to watch those videos. As you get more and more experience, you learn to spot, okay, this one looks shady. No, this one can be trusted. But I'm just giving it to you in the textbook level right now. And so we see that all these questions have been answered.
yeah, Pierre, I was gonna say that looking at this, how this that peak level, the highest level, underneath that place where it says price will respect quality, that highest level there, how it's gone and it's coming down, we anticipate it's going south. That's literally like the candle for that week forming.
I'm just about to show you that in a second. Now let's look at that candle for last week in GCAD. This is the candle here.
Sorry, where are you?
This candle.
Yeah.
Right?
It's forming.
No, this is the one for this week.
Okay.
This is the one for this week. That's already forming.
It's forming. The one for this week is still forming.
Actually, hold on a second. No, that's not right. That's not right. Something's not right. Let me see. So that's the week of the 26th. Go down to 1 hour chart. So that's that day. Okay, so that's this day. So that's the day. Oh no, we're looking at a day. So that's a day there. This would be the week. Yes, that's the week. So the week started down there, right? It runs into that level there, and it drops sharply.
And respects that place.
It respects that level.
Yeah.
That week you see there, that's the week on a 4-hour chart. It came up here, came from down here. It ran into that level that we already determined from the previous week.
Okay.
If all you did is just draw this line here, look at this here, right? From the week before. See this from the week before? See that low there? Just draw it out. See the magic? That low there, right? Is what that high there is respecting. That's the level. This is the liquidity pool. It's the other block, right? This is the signal, the fact that it respects it, and it forms a market structure break there. The entry pattern is a 61.8 or 78.6 level on the Fibonacci.
Okay.
The money management and the trade management is we're doing here. This will be 30 pips, 4 to 1. And the trade management is when we get to Friday, which is a day where we expect to see a reversal, right? We get to Friday, there is a low there. So that's a liquidity pool. And there is another block in here. When it gets there on a Friday, we get out. 100 pips, simple. And the question is, where's price coming from? From a significant level. Where is it going to? Right? It's going to either here, we said from the start of the week, it's either going to here or here. What is it likely to do along the way? Well, it's not likely to just do, if we started from here at the start of the week, and we know we're going to either here, which is 240 pips, or here, which is 300 pips. Is price likely just to keep going straight up for 240 pips? No. It's going to expand and retract, right? And so when it does this, when it comes here, and then it comes back down, are we worried? No, because on the way, we expect it to retrace a little bit. And so all this is an opportunity to get into the trade if we were not already in it. Now, when it gets to where it's going and it changes direction, so it's now coming from here, right? It's now coming from here. Where do we think it's going? It's already broken this level, so to the next liquidity, so it's going to here. What is it likely to do along the way? Is it likely to travel 150 pips in a straight line? Very unlikely. Not impossible, but very unlikely. So what's it likely to do? It's likely to retrace first along the way. And this retracement is your opportunity to enter, right? Then it goes fully to where it wants to go. Capiche?
Yeah, I'm remembering what you said, that an elephant cannot enter into your garden without leaving traces.
Without leaving signs. It has to tell you it was there and where it's going. It doesn't want to, but it has no choice.
I need to go and watch the rest of the videos. This was so informative. Very, 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 very.
Sir, as you're just talking, as you are analyzing all of this for this short move, I have been looking at where price is coming from and trying to see the structure break, trying to see at what point one would have been able to enter and all of that before the reversal. That's on the left side now.
Yep.
I said I've just been.
What are you seeing?
I've been trying to apply it to the left side from where price started from.
So show me what you're seeing, or describe what you're seeing to me.
Okay, like where price is starting from before we had that structural break to come south. Exactly at that point where it is starting from. I know that I know. No, from where it, no, not at the top, from the bottom.
Here.
All the way to the bottom.
Oh, here.
Exactly.
Okay.
So I've been looking at all of that to the top where it got to, and then we had the break of the structure, and then price started coming down. So I've been looking at this whole side too, like everything you have been saying, just to try and apply to that point, because I know there are trading opportunities all along there for a buy. So I was just trying to put it all together.
Yeah, true. Like I said, if I was analyzing this for a buy, yes. But remember, I said my own scenario coming in would have been to wait for the sell. Does that make sense? But okay, so let's analyze it for a buy. Good point. Let's apply the same principles for a buy, right? So let's drop down to 15-minute chart. By the way, if you are trading intraday, 15-minute chart is your baby. If you're trading intra-week, the 1 hour chart is your baby. Does that make sense? If you plan to be in and out the same day, be looking at the 15-minute chart. If you plan to be in and out the same week, the 4 hour chart. Also the 1 hour chart.
So which one do you?
Yeah, go on.
Which one entails you looking at the 4 hour chart then?
If you're a swing trader.
Swing trader, you just.
Yes, if you're an intraday trader, the 15-minute chart should be your entry chart. Okay. If you're an intra-week trader, the 1 hour chart should be your entry chart. If you are a swing trader, the 4 hour chart should be your entry chart.
I'm guessing you talked about these kinds of traders.
We did, but we'll talk about them again. Okay. We'll talk about them again. So, Sonny, this is your question, right?
Yes,
On
sir.
this day, price comes into that level, and there is a market structure to the north side. See that there? Right?
Yes, sir.
So it breaks structure there.
Exactly.
And then the next day, what do we have? Price opens here. It dips beneath that level, beneath the open price, and reacts in that order block. Now, I would not take this trade because I still need it to show me more, right? But it reacts here and it closes above. Remember we said we want to see a significant close above the open price. So this day tells me this price is now ripe, right? Exactly. So I'm not buying the whole of today until it closes today. Where does it close today? It closes here. This is the close for the day. This is the close for the day. Let me remove this here because this is just to show the market structure break, right? So this day tells me, okay, we're okay to buy now. Especially because we would expect this to happen for it to close at that level. So tomorrow, this is the day where the opportunity to buy really happens, right? It's this day right here. Let me put it in there. Insert. Buy. So this is the first day where I'm actually looking to buy. It's the 23rd of June. Let me see. What day of the week? So today's the 28th, right? So 23rd. What day of the week will the 23rd have been?
So today is 28.
23rd was a Tuesday, right?
Yeah.
Right?
Yeah.
Right? Tuesday.
Exactly.
Go on. Okay. So on a Tuesday, I'm looking between 6 and 10 a.m. in London or 12 and 3 p.m. in London. 6 a.m. is 8 a.m. on my 6 a.m. London is 8 a.m. on my chart. So 8 a.m. I'm starting to stock a buy. 8 a.m. on the chart. So this 8 a.m. on this chart would be 6 p.m. in London.
6 a.m.
6 a.m. Sorry. So between 6 and 12, 12 would be 2 p.m. So let me draw a line there. So I'm looking between here and here, 2 p.m. Actually, 12 p.m., sorry. 12 p.m. because it's 6 to 10, right? Now, you could say, well, if I'd entered this trade here, I would have been in trouble, right? Right?
Yes, you can say that.
You know why you would have been in trouble?
Would it be for stop loss or something?
No. Where did price open that day? Where the price open? Here, right?
Yeah.
Have we gotten below the open price?
Oh, yeah.
Have we gotten below the open price?
Yes, we have.
No, we've not.
So, okay.
Between 6 and 10.
Okay. No.
Have we gotten below the open price?
No.
No. Now, there are days where price will form that and just go and leave you behind. It happens. Now, the question is, are you disciplined enough to say no to a good trade because it doesn't fit your rules? And this is why these rules exist, to save you from days like today, like this day. So it's a Tuesday, sorry, meaning it's giving you a good trading opportunity. But pricey, this is what you call a manipulation.
Yes,
We spoke about engineering liquidity.
Yes, sir.
This is something the market maker does intentionally.
Yes, sir.
And in fact, let me tell you how people like me trade. Until we see this, we don't enter the trade. We wait for quote unquote Otuns. We wait for the orders to fall for this. And then when this happens, it proves to us that something is now happening. When does that happen? When does this trade materialize? 2:30 server time is 12:30
London time.
London time. So this would be 12 o'clock London time. And we're watching it from 12 o'clock London time to 3 o'clock London time, which would be 5 o'clock server time. So that's there. So the only two times this day where I am interested in a trade are between in this point here, right?
Mm-hmm.
Not you, I'm looking, yeah. And this point here. I don't have any business. Let me even remove this. Let me move this level here.
I think you would also prefer the second point to the previous point.
I'm coming to that. You're right. But my point is, I'm only looking to take a trade between 6 and 10 a.m. in the morning and between 12 and 3 in the afternoon, right?
Mm-hmm.
So 6 to 12 in the morning, has price met my conditions? Is it below the open price? Or has it gone below the open price at any point in the day up to that point?
Mm-mm.
Has it?
No.
No. So do I take a trade here?
No.
No. But it's giving me a perfect manipulation that's going to engineer liquidity. People are going to put their stop loss there. Anybody buying is going to put their stop loss there. If you're buying and your stop loss is there, your stop loss is going to be a sell, right? If the market maker needs to buy, they need to force you to sell. So when you buy here and put your stop loss there, and they trigger your stop loss, it gives them the liquidity they need. You are now forced to sell to them because your trade is stopped. They take the other side trade and they buy. Also, breakout traders, yes. Breakout traders, okay, price is going down. Once price crosses there, they say, oh, it's broken market structure. It's time to sell. No. You missed the anticipation for the day. The directional bias for this day was where?
Up.
So we're only interested today in buying. We're either going to not get an opportunity to buy, or we're going to buy and take a loss. Uncle Ale is giving me the thumbs up. Or you are going to buy and win. So today, thank you for clapping, Gerard. The only three scenarios today are I miss the trade altogether, I take a buy and I'm stopped out, or I take a buy and I make a profit. At no point today am I selling.
Wow. So
look at, go on.
I was going to ask, this engineered market manipulation is to ensure that people that buy have to sell at a low price and they lose money.
Yes. And it's intentional. And it happens almost every day. Look at your chart. It will happen almost every single day.
And I'm guessing
something of this nature.
Breakout traders in another video.
Yes. Now, this is the final piece of the puzzle. Remember, today was the day that convinced us that the next day, or this day here, was the day that convinced us to buy the next day, right? Because we expect price to reach that level. This day confirms to us that price really has turned upwards. So Tuesday, 23rd is the first day we're buying. Well, where was the low of price on the previous day? Down there, right? You see that there?
Yeah.
What level did that low respect? This here. What's the order block that low respected? That one. Can you see that?
Yeah.
In essence, I don't know I'm buying till the end of today. I'm not jumping in here. And notice, even if I jumped in here, how much money would I have made?
Not much.
45 pips. When the next 2 days, I could have made, looking at just the bodies of the candle, I could have made 150 pips. Why risk? Because this could very easily have gone back down. Why risk a low? Why risk a low probability 40 pip trade when I can get a high probability 150 pip trade? But this Monday, and also it's a Monday. Why am I forcing a trade on a Monday when I know the most action happens Tuesday, Wednesday, Thursday, right? But after this Monday, price has told me that that's the level it's respected, right? So what do? I put my Fibonacci there, from there, right? To where is the high that day? There. Where is this entry? Can you see this? Is between 61 and 78. Can you see that there?
Yes.
Let me take out the red lines so that you can see clearly.
I see it. Yeah.
So you see how many pieces of confirmation? Our directional bias has been respected. Our time tendencies have been respected. Prices come below the open of the day, between 12 and 3 p.m. in the afternoon. And it's given us so if this is the range, remember I said this here, and then this day going up tells us to respect that low and that high. So if that is the fair value range, we're looking for a discount. If we want to buy, we're looking for a discount. We're going to buy. We're going to wait for it to form beneath the high, the open of the day, between 61 and 78.6, right there. And there's a reaction. So my entry will be here when it comes back above this level. That's my entry, right? That could be my stop loss if I believe that's the low of the day. 20 pips. Because I now believe that's the low of the day. Even if I don't want to take it, I just go to the low of the previous day. That's still, okay, 47 pips still. But then where's my target? This level here. Remember, we drew that level up before the week.
Yeah.
150 pips. That's still almost 4-1. And don't take any trade less than 3-1. Never take a trade less than 3-1. But look for trades that are at least 4-1. 4-1 is my standard and above. But if I see 3-1, I'll take it. So I believe this trade could give me 4-1. So is it a worthwhile trade? Yes. Could I lose it? Yes. But again, if I'm making 4-1 on each trade, even if I'm 50-50, right? Out of every 10 trades, 5 times 4 is 20%.
Mm-hmm.
The other 5 trades are 5%. So 20 minus 5 is 15%. Again, if you're making 15% every 10 trades, you're still doing very well. But with these other filters that I showed you here, right? These other filters here, this is where they come in handy. These questions that I taught you to ask, these will get you from 50% to somewhere in the region of 70%. Now, if you win 7 out of every 10 trades, which you should have no problems doing when you become confident with the principles we teach. If you're winning 7 out of every 10 trades and you're making 4% on your wins and 1% on your losses, somebody do the math for me, please.
Okay.
What's 4 times 7?
4 times 7 is 28.
What's 3 times 1?
3 times 1 is 3.
What's your profit? 28 minus 3.
25.
So every 10 trades, your account grows by 25%. Think about that. If you're risking only 1% a trade, how long will it take you to make roughly? If you make 3 trades a week, then you're going to have roughly 10 to 12 trades a month, right?
Mm-hmm.
If your account increased by 25% every month, what do you think would happen?
Wow. That means in 4 months, it's going to increase by 100%.
That means you double your account every 4 months. And that's assuming you're not increasing your risk, because as your account grows, at the end of every month, we calculate your risk to the size of your account that month. Does that make sense?
Mm-hmm.
That's how I do it. Every month I recalculate my risk. So 1%, I use that 1% for that whole month. And then the next month, I now use 1% of my account at the start of the next month for that whole month. So compound interest will mean your account has more than doubled.
Wow. So you make some profit, then out of the profit you make.
This is how to responsibly trade and make money. Not by over leveraging your account, over risking your account, losing 50% of your account in one trade because you're greedy, because you want to buy a Bentley like the guy you saw on Instagram, and you don't realize the guy on Instagram hired his Bentley to impress you, to take money from you.
Wow. Phil.
What leverage are you advising, sir?
Say that again.
What leverage are you advising, sir?
I don't care about the leverage. I just care about the risk. 1% of your account in any trade.
Okay.
Whatever that leverage means. If you're only losing 1% of your account in every trade, you need to take 100 trades to blow your account.
That's true.
And remember, at the end of every month, if your account is lower, you reduce your risk to the new. You're right, remove those plantain chips. You know what? You know how much I like them. Take them away.
I was going to say, when I make money, I'll buy a box.
Don't tempt me. So you get the point, right? This is how to trade. Now, this looks perfectly fine to you now. The moment we get off this call, you will look at this tomorrow and ask yourself, what did that man say again? I can't see all the things he was showing me again. That's fine. I'm going to record this. I'm going to edit this video and upload it on the channel without your faces. Right?
It's fine.
Go back, excuse me. It's almost midnight here. Go back and watch it again and again and again. And practice the same thing on other charts. For instance, look at this week on any pair you want to trade and go through the principles. What's my directional bias? What are my key levels? What are the significant time periods and the tendencies? What do I anticipate for my scenario? Right? What do I think will happen? Even if you're wrong, it's fine. What will be my signal? When my signal happens, what will be my entry pattern? How will I manage my money and manage my risk? And how will I manage my trade? Where will I enter and come out for profit or loss? In the process, I have to believe price is not random, meaning if you believe price is not random, it means you can predict what will happen. If you do not believe price is not random, don't bother trading, because you're not going to have, when things start to happen, you're not going to have the confidence to act on them. But if you believe that price is engineered, then you can begin to spot the market maker's behavior and say, I know what you guys are doing. I know how to take advantage of it. Does that make sense?
Yes, it does.
And then always, before you take a trade, where is price coming from? Meaning, what liquidity level is it coming from? What liquidity level is it going to? What is it likely to do along the way? Where it's coming from. One second, let me put this here. Where it's coming from and where it's going to will give you entry and exits. So where it's coming from will tell you where it's going to will give you your exit. What it's likely to do along the way in relation to where it's coming from will give you your entry. Does that make sense?
It does.
So once you figured out where it's coming from, you're looking for a retracement in the opposite direction of where it's going to give you an entry. So at what point in between the first bus stop and the second bus stop is it likely to give me a chance to get on board? Does that make sense?
Yes, sir.
And that's your entry. Now, this is not going to make you're not going to become a gangbuster on day one. One second. What's it likely to do along the way? You're not going to be perfect at this on day one. It's going to take time, right?
Yeah.
And practice. But go and use these principles for yourself to start practicing. Send me or just post on the group, either myself or Talkmail or Joshua will respond to them. Send us your analysis. This is what you think is going to happen, right? And that's why you have a demo account. Without losing money, take the trade on your demo account. If you win, don't get too excited. Ask yourself, why did I win? If you lose, don't get too depressed. Ask yourself, what can I learn from this loss to apply going forwards?
Mm. Wow.
Comprende?
Oui.
I move the motion that we all go and sleep.
That's
Thank
a
you
good
very much,
motion.
sir.
Very good motion, sir.
Much appreciate it.
You are very welcome.
Thank you, sir.
Very good motion.
Bless you.
You are very welcome.
All
All right, guys. Take care.
Thank you.
Bless you. Bye-bye.
Bye-bye.